broadcast in just about now. And welcome to the Smart Money Simplified podcast with your host, Brent Mekosh. Brent, good to see you. How are you?
Bill, always good to see you. I'm excited for our conversation today. We've had a little bit of a recurring theme here in maybe the last 4 or 5 episodes or so, where we've had some folks coming on to talk about some different alternative asset classes. And I think today's conversation is pretty important. If there's something, 2023, pretty good year. As of the time we're recording this, it's January 7th of 2025, and 2024 was a pretty good year. But 2022 taught us a lot of different things. And one is
Mm,
that assets that don't appear to always be highly correlated sometimes can get fairly correlated. And we had that in 2022, where you had NASDAQ was down 30%, the S&P was down about 20%. Barclays Aggregate Bond Index for the first time in anyone's lifetime that's alive was down double digits, which just doesn't happen before. And it gets you thinking about what are some other investment strategies, what are some other alternative asset
yep.
classes that should be incorporated in portfolio management. And one of the reasons that we've been fairly engaged with those assets for several years now, but increasingly so as time continues, is that it's just, quite frankly, you have the opportunity to build better portfolios when you start to look outside the box and consider something outside of stocks, bonds, and cash when it comes to investing people's money. So I'm excited about today's guest. He knows more about this space, probably in his little pinky, than I do in my entire brain. So it's really good to have him here. His name is John Hampton. He's the executive director over at Campbell Corp, and they've got really, really cool strategy that they employ in the alternative space, and we think anyway has the potential to add quite a bit of value. But John, greetings from you're down in Texas, I understand, huh?
Yes, where we actually think it's cold today. It's in the 20s, and it's not normally this frigid cold, but you were complaining about 60-degree weather in Scottsdale. So,
Yeah, yeah. Well, I did. I saw the storm map, and yeah, we're about 60 degrees outside right now, which means I'm wearing my overcoat. But in Texas, there's a giant white patch sitting right over. I think you're in Dallas. Is that correct?
that's right. And rumor has it that Jim Cantori's on his way here Thursday. So that's never good news, I don't think. So,
No, but it seems like you guys get that in Texas about once a year or so. You get something nasty that rolls through and just shuts the
yeah.
entire state down for a little while.
Well, and most people here aren't prepared for it. So it'll be interesting.
Oh, well, good luck dealing with it. So tell me
Thank
a little bit about a little bit of your professional journey. What got you to where you are today with Campbell and Company?
Great. Number one, thanks for the opportunity to be with you. And yeah, just to tell you a little bit about myself, grew up in rural Arkansas. That's where I get a little bit of this accent from. Graduated from college, had a couple of different stints in the retail department store business, and then went to work for International Paper Company for several years. After a successful career there, helped roll up an IPO of some transportation companies. And when I finished that stint, I actually kind of moved into the industry that I'm in now, the investment side of the business. I was an advisor for several years,
Mm.
actually sold a practice. And at the culmination of that, I was approached by Campbell and Company, and they said, John, we've heard about you in the marketplace. We know you've raised money for alternative assets. We've got a territory in Texas. It's our worst one, and we need some help. And I thought, well, yeah, if it's in last place, I mean, I guess I can't screw it up. So
There you go.
I joined in 2011, and as that's approaching 14 years in December. That's an eternity for someone that does what I do. Most people don't stay in that role, but I love Campbell. It's been a great place to work, and I plan to retire from Campbell. So just a great company, very innovative, and look forward to speaking to you a little bit more about what we do.
So when we talk about alternative assets, that's a really big term. How would you define that? Because I would define it in terms of there's a difference between obviously alternative assets as an asset class and also alternative strategies. Can you break that down a little bit in terms of what that means to you and the folks at Campbell?
Yes, you're right. Alternatives cover a really a large swath of different products. My explanation is very simplified. I look at traditional assets, stocks, bonds, cash, as assets that most people are familiar with. Some people may be in a 60-40 balanced portfolio that really only contains stocks, bonds, and cash. So we consider an alternative anything that's not one of those. So that could be real estate, that could be private credit, that could be hedge funds. It could be systematic macro funds like ours. If you look at the Yale endowment and look at what David Swinson's done there, it's encompassed things like timber and minerals. So, we think alternative assets should be things that you don't traditionally think of as what you'd see in the Wall Street Journal when you look at financial instruments like stocks, bonds, and cash.
You mentioned obviously some of these big Ivy League endowments, and when you look at really when you go up the scale from say your a smaller retail investor all the way up to some of these very successful large institutions, you see an increase, a really dramatic increase, quite frankly, in the holdings of alternatives as an asset class, which again encompasses alternative assets as well as different strategies. And you're seeing a corresponding level of increased success in many cases with some of those larger portfolios. What do you attribute that to? Why is it that incorporating these assets has in the past anyway tended to lead toward better outcomes? And why are people with large pools of cash that we're into the billions and tens, if not hundreds of billions of dollars, looking at these as viable investments and viable strategies?
Yeah, it's interesting. Campbell, as we'll talk about, is just one piece of a larger alternative, I'd say piece of the pie.
Hmm.
But those things range from being illiquid, real estate, to some private equity funds. I've always thought liquidity is a portfolio decision, not necessarily an investment decision. Most wealthy people own some things that are less liquid. They have to be patient with those, that they mature over time. But although I'm not here to represent real estate, a lot of people have made a lot of money in real estate,
No question.
private equity, which can be locked up for a period of time. And I think they just have a different fundamentals. They operate differently. I think I used to say liquidity can be your best friend and your worst enemy. I think it's nice to have liquidity built into your portfolio, but everything in your portfolio does not have to be liquid. And I think sometimes there's a premium that you can gain from owning a alternative asset that may be less liquid if you are patient enough and have the financial wherewithal to stick with that investment till it, comes to full fruition.
I 100% agree with that. I think obviously maintaining short-term liquidity you've got to have some of that. But to your point, it can be a great friend, but also an enemy. And it can often give you the opportunity maybe to make some decisions that you don't want to make or shouldn't be making at the time.
Right.
I think that there's quite a bit of truth to that. So talk to me about Campbell. Where do you guys play in the space?
Yeah. So Campbell and Company started in 1972. So we're the oldest continuously traded, I'll use this term CTA, which is a commodity trading advisor. Don't let the name fool you. We do more than commodities, but the industry knows us as a CTA.
Talk about what that is. Break that down a little bit for our
Yeah, so
listeners.
Commodity Trading Advisor is a company that trades futures contracts in various instruments. And so in our strategy, we have three broad geographies. So we trade Asia, Europe, and North America. So if a person invested with us, their money would be working 24 hours a day, 6 days a week, because those markets are open 24 hours. The breakdown of what we trade would be four very broad buckets. One of those would be commodities, which is in our name, Commodity Trading Advisor. So that's everything from energy to metals to agriculture. One of the other broad buckets that we trade are what some people shorten and use as FX or currencies. So it's a very broad, very liquid market. You can trade developed market currencies, emerging market currencies. So we like that particular strategy. The other two buckets would be interest rates, what a layperson would call stocks and bonds. And then the fourth bucket would be equity indexes. So we trade futures contracts in all of those four instruments. I think, Brent, one of the most unique things about what we do is we can be bi-directional. So we're not a one direction bet. So, as you know, the stock market goes up most of the time. It's a great place to have some of your client assets, but it doesn't always go up. And you referenced 2022, a year when equities and bonds didn't do well. They were both down and both down double digits. So we have the ability to benefit when assets can go north or south. We can be long or short in any of those instruments.
Now, are you looking at making the directional bets either long or short, or are you just looking to capture a spread?
Both. We'll do both.
So
You know,
any given time, is there a bias toward the portfolio, or is that constantly
no,
changing?
we'll pretty much, to kind of back up and talk to you about how we do what we do. I think it's interesting to look at our roots. Our founder, Keith Campbell, started the firm in 72. You'll get a kick out of this. His soon-to-be partner came in and said, Keith, everything you're doing manually could be done by writing code and having a computer trade these instruments. And so they began to do that. They began to write algorithms, write code that would actually trade our assets. And we've done that now for 50 plus years. I always find it interesting. One of Keith's contemporaries, if you're a baseball fan, there was a movie called Moneyball, I think in 2011.
Yep. Great movie, Brad
The
Pitt.
premise of the movie Moneyball was you took a young fledgling team that was trying to build a great team but stay way under the salary cap. And the way they did that was they used algorithmic principles. They looked at statistics on the different players and tried to find these diamonds in the rough that had opportunity. And at the end of that movie, the guy that owned the Red Sox that was trying to hire Billy Beane was a guy named John Henry. Well, John Henry and Keith Campbell were two of the pioneers in this systematic algorithmic space. And so what we like about using algorithms to trade money is we think it takes the fear and the greed out of the equation. Many times we might bring a bias into whether we like gold or whether we like the euro or whether we're pro the stock market or pro the bond market. Everything we do is done systematically and based on algorithmic principles.
And so give me an idea in terms of as you're building these models out. Obviously, once you let the computers rip, you can let them rip, but it's got to be based on some kind of philosophy or some sort of thought. Can you dive into that a little bit more in terms of what the overriding philosophy is?
Yeah, that's a great question. So you are correct. Once you build the algorithm, once you've tested it, once you have faith in it, you just kind of let it run and you monitor it. But let's back up to how we build the algorithm. So we have 20 to 25 of the top research staff in the country that work in our home office in Baltimore. And their degrees are in applied math, engineering, physics. They're really, really the best and the brightest. And everything starts with an investment thesis. So they may be looking at the relationship between gold and the euro, or the euro and the US dollar, you name the instrument. And they begin to do research on, the relationship and how we might be able to benefit from inefficiencies between markets. So they build an algorithm. They have to present it to that very bright group of people. We call it peer review. So it goes through a peer review just to see if the algorithm seems to have merit. If everybody gives it a thumbs up, then it goes to our investment committee. Investment committee looks at it. If it gets a thumbs up, it eventually goes to our executive committee, and we begin to trade it with fake capital at first, and then eventually we apply real capital to it, constantly monitoring to see if what we intended to happen actually did happen. Once we have faith in an algorithm, it takes a while for us to decide to decommission it. It has to really be broken. We try to fix it. If we can't fix it, we'll decommission it. So we've built, 30 plus proprietary algorithms over our history. The beauty of having algorithms run your money is they never miss work. They never show up late. You can scale quite a bit of money, and you don't have the key person risk that you'd have. One of the things that people are looking at now is what happens to Berkshire Hathaway when Warren Buffett, goes away, or a Bill Gross. We don't have a person that makes our investment decisions. They're made by the algorithms that have been built by our team. So
now, what kind of safeguards do you have in place for that? Because a phenomenal book written in the late 1990s called When Genius Failed, which is about rise and fall of long-term capital management. And those of us that were in the business remember that the Fed had to come in with a consortium of banks and bail them out, and there was systemic risk that was built in pretty much they were so big throughout the entire financial ecosystem back there in New York. And what's odd about that, or what's kind of interesting about that story, is that the guys at Long Term Capital, they ended up being right. The folks that assumed those positions when they went belly up actually ended up turning quite a profit on it, but they couldn't outlast. The spreads widened to a point where bigger than anybody ever expected, and they couldn't outlast that. So, what sort of risk management do you put in place to make sure that you're not cutting the algorithm? If it's ultimately going to be right, you want to let it run, and you gotta withstand the short term volatility, but you also don't want to let it put the firm at risk by believing in it too much. Do you understand
No,
what I mean by that question?
that's a great point, and it's so funny you say this. There have been times when I felt our algorithms were correct, but what was going on in the market wasn't agreeing with
Yeah.
what was going on with our algorithms, and so we do have faith in them. We do let them run, but we have risk built into everything we do, and so when I say that, we have a standard deviation risk target for our strategy overall, but that starts at the grassroots level. So when I talked about those four broad buckets and those geographies, we have risk parameters around each one. We monitor those risk parameters to make sure we don't get out of balance and get outside of the band of the risk target that we have. And if we do, our algorithm systematically, our risk will kick in and cut back. A great example of this was March of 2023. If you'll remember March of 2023, anybody that knows
Silicon
what
Valley
we're
Bank.
doing in our space was short fixed income. We had been short fixed income the whole prior year. We had a Fed that was raising rates, bonds were going down. March of 2023, we were deep in that trade, and along comes the announcement of the SVB financial crisis. What happened then was there was a flight to quality, and many firms began to load up on bonds. We were short bonds, we and everybody else. So you would really expect your P&L to not cooperate with that particular environment. About a day before SVB was announced, we cut our risk about 20%. So we went in systematically and we cut about 20% of our short fixed income trade. Now, I'd like to tell you that was all skill. I think some of it was. We looked very, very bright. We ended up with a very, very small loss in March. Many of our peers had 3.5 to 10% losses in 1 month. So that's an example of we could have stayed in that very profitable short fixed income trade, and yet our risk kicked in, took a 20% off the table. That could have worked against us. If that had continued to do well, we might have sacrificed some gain, but we were trying to protect against a black swan, type event. So
Right.
I'm happy to say our goal at Campbell is to try to make you money, but we also don't want to blow you up as well. So
Well, yeah, and that's always the best solution for sure. So you mentioned obviously you're trading in big global markets around the world. Is now one of the things that I think has been really amazing about what's occurred in our industry in the last 20, 30 years or so is that very advanced strategies like yourself have been largely democratized, where technology has allowed you to do it, the liquidity available in the markets has allowed you to do it. Do you find that your space now that you're operating in, does it benefit from the fact that you're seeing increased liquidity, increased volume, increased interest in these markets, or are you getting crowded out?
there's a balance. I think the more participants you have in the market, the more liquid it becomes. So liquidity is important. Of the four buckets we trade, the broadest, most liquid is the currency market, is huge. The least liquid would be commodities. There are certain commodities that can be thinly traded and can be easy to get into but hard to get out of. So one of the things back to the risk component, we try to trade commodities that are fairly liquid, WTI, Brent, natural gas, things like that. So we never want to get in a situation where we can get in, but we can't get out.
Right.
So that's important to us. So having lots of participants in the futures market is a good thing. It creates liquidity opportunities. But I do think people talk about trades getting crowded. when we started, I mentioned or I referenced we were one of the pioneers in the business, and now there are a lot of participants in this business, but we all do things a little bit differently. And I think Campbell has some edges that we could talk about in a moment. We do things a little bit differently. I think our risk we handle differently. If you look at the speed of our trades and the look backs on our trades, we tend to be a little more nimble, a little bit faster than some of the other people that do what we do, and I think that's really benefited us. So
Now, how are you doing that? Is it just a product of better technology, or is it data feeds, or how are you getting that edge?
well, technology is certainly important. I referenced that we trade 24 hours a day, 6 days a week. So when you do that, you have to have redundant systems. So, we have backup systems, two phone systems. We have a disaster relief situation where, if we had a natural disaster or heaven forbid, something that allowed us not to trade for a period of time, that we've got to have redundant systems. That's kind of baked into our DNA. So that's important. Um, the speed with which we can trade is important. So we always have to have good data. We have to have good systems to trade with and the ability to know that we can execute. Those are all things that are very, very important. But it's something that we're constantly working on. And then, I mentioned, like any place, your employees are probably the most important thing. We have, a great research team that's always looking at new and innovative ways to trade. A couple of things I can think of. When Brexit happened a few years ago, we built a Brexit model around things like sterling, around the euro, things that could have been impacted by the Brexit vote. Now, I think anybody that thought they knew how the Brexit vote was going to turn out was probably wrong.
Right.
So that's one of the things that's really, really interesting. We had to be prepared either way. We had COVID models. Sadly, I hope we never experienced that period that we did, like COVID, but we had models that traded based on things that were going on with COVID. We have taken weather data and built models to trade grains and other agricultural items based on weather patterns. It's really, really interesting. We just came off of a U.S. presidential election, and while we're agnostic, from a firm standpoint as to who was elected, we did know that there were a certain set of things that would happen under a Harris presidency versus a Trump presidency. So we have what we call a risk library. We kind of
Mhm.
looked at these different variables so that we could benefit from that event and not get hurt too bad, depending on how it turns out.
So are you looking at when you're looking out at the overall macro landscape, are you considering like big tail risk, like a COVID event, like global war, like pick all your worst case horrible scenarios. Do you guys model for that?
Yeah, as best we can. I mean,
Mhm.
there are black swan events. When 9/11 happened, no one in their wildest dreams could have conceived that an aircraft would have been taken over and people killed on that aircraft and flown into buildings. I mean, I don't think that was in our thought process. I would call that more of a black swan event.
Right.
But you have to be prepared for those and react to those. In I mentioned everything we do is basically systematic. There's been a handful of times, 9/11 being one of those, where we went to cash. We unraveled things just because we didn't know how long the markets were going to be closed, didn't know when we could be back trading again. The Asian tsunami many years ago, when there could have been nuclear fallout, another situation where we went into cash. That's only been a handful of times. We just typically let the algorithms run, but you have to, react to things. And, I hate to say it, but there'll be something happen in the future that we've never seen before, and our models will have to react to that. But much of what happens are things that are predictable. You're going to have recessions, you're going to have expansions, you're going to have elections, you're going to have Fed decisions, not only domestically here in the U.S. but across the globe. And so there are some things you can model and predict, and to the extent that you can get good at that, it can certainly help the outcome of your performance.
So we're here in a new year, obviously started 2025. Do you have a consensus for what the world might look like this year, both geopolitically, economically, sort of in all these different buckets?
Right. Well, Brent, my crystal ball is pretty foggy, but I will tell you one of the unique things about what we do is we don't have a house economist. We don't really have someone that gets up and speaks about what we think about the economy. We like to say we're agnostic, that we can make money in any environment. And that's why, back to the presidential election, while you and I might have had our favorites as to who we wanted to win the election, we could potentially make money at Campbell under either regime.
Hmm.
We've done that for 50 years. We've made money under Democratic regimes, Republican regimes. We've made money during recessions. We've made money during expansions. We've survived a global pandemic. So, while we don't try to look out over the horizon and say what we think is going to happen, we know that our models can get it right over time. They might not instantly get it right, but over time they will figure out which direction this market's going. I would say that really didn't answer your question too well. I would say this, that we came off of a period of time. You referenced 2022. 2022 was a great year for us. We were up, north of 30% in the strategy that you and I are discussing. And that was largely because we had a Fed that was very accommodative. They told us what they were going to do and they did
You
it.
did. Yep.
And so they raised rates, bonds went down, we made money shorting bonds. As that happened, the US dollar got stronger, so we were long the dollar. First half of the year, we were long commodities. If you'll remember, that's when Russia invaded Ukraine. A lot
Hmm.
of grains are grown in that part of the world, so grain prices spiked. Anytime there's sword rattling, energy typically goes up. We made money there. Second half of 2022, we had China coming out of its COVID shutdown, so commodities we got short on those. And then the last and most least important was equities. We made a little bit of money in equities, long part of the year, short part of the year. So that was a great year for us and a really good test case for why something like us could make sense. You had traditional assets that were not only both down together, but down double digits.
Hmm.
And we were one of the bright spots. Now, fast forward to a year like this year. This year was a tremendous, at least this year, this is 2025.
2024.
2024 was a great year for equities. Equities did phenomenally well, and we did well right alongside them. This particular strategy was up, 11.64, just under 12%. So you have two extremes. 2022, when nothing seemed to work right, we did really well. And last year, 2024, when equities did well, we did well, right alongside them. So.
It's interesting too because you did it in what, at least historically speaking, in 2024 was a fairly low volatility environment.
Mhm.
So you didn't
Yeah.
necessarily need that volatility which you had in spades in 2022
Yes.
to get that measure return. I want to go back to technology. So you mentioned the company was founded back in 1972. So it was a year before I was born. I was born in 1973. The
Right.
fact that you were very proactively using computer technology, which at that point we're talking punch cards and computing power of
The computer was as big as this room I'm in.
yeah, exactly. And now, we're here in 2025 at the start of the second quarter of the century, and obviously massive impact, I think, in every industry that we're just starting to see of AI. Are you incorporating any kind of artificial intelligence in your strategies now?
Yeah, it's really interesting. Our CEO has really commissioned a study on AI, and there's this term called machine learning. Kind of you'll see machine learning used with algorithms with Facebook and other firms on ads and things like that. We never really touted it a lot, but we have done some work with machine learning. We've done relative strength, trend following, non-trend following. Um, but really are looking at the impact of AI and how that might impact our business. We're not one of those that are super fearful that it's going to replace Campbell and what we do. We actually think it's a tool that can make the people that do what they're currently doing now faster and better.
Hmm.
So we're not fearful of it. We think it actually has its place. And, it could create productivity, efficiency, but I go back to what really makes Campbell great are our people, from our research team and that really build the algorithms, come up with the ideas for the algorithms. My team, which is I'm part of the sales team, we think this is a product that's you have to be sold to use. People don't just go on the internet and buy a particular product like this for the most part. They have to understand what it does, why it does it, what it does. And so, again, it all goes back to people, but we're not concerned about AI. We think that it will enhance our ability to do our jobs better.
Okay. Now, what kind of, you mentioned that most of the people that are looking at these strategies, it's not something that they're necessarily stumbling across. It's probably fairly intentional, whether it's on the advisor side or the individual investor side. Are most of the investors with you guys, are they large institutions? Is it retail? Where's most of the money flows coming from?
Yeah, that's interesting. Contrary to some firms, we do have an institutional side.
Hmm.
It's not the largest part of our business. The largest part of our business is our private wealth, calling on advisors like yourself, RIAs, that are dealing with individual clients. So a lot of money coming from that side of the business. We like that because it's stickier. We think that advisors, as a former advisor myself, I think one of the keys to financial success are for investors to find a good advisor, trust them, work with them, listen to their recommendations. I think you're going to come closer to winning the game than you are being a do-it-yourselfer. So we think the advisor community is important, and when they place assets with us, when I say they're stickier, they've educated the client on the strategy before they've ever put them into the strategy, and therefore the money doesn't just come in and go out. It
Right.
stays in. And so some firms that do what we do large blocks of institutional business. We do some institutional business, but a lot of ours is, private wealth clients coming from the IBD side of the business, the RIA side of the business, and there's strength in numbers. So we're about a $5 billion firm. We didn't talk about that.
Mhm.
That's tiny compared to an American Funds or a Fidelity, but it's a fairly decent size for a CTA.
Right.
Most CTAs would love to be $1 billion in size. That's where you start to reach scale. And we're at 5 billion. I will also tell you, bigger is not always better in our space. When you get to double-digit billions and you're trading large blocks of commodities, it gets a little more unwieldy. So we think the $5 to $8 billion size, under double digits is a good size to be for what we do.
So investors that are either in your fund or considering it, what should they be? What are their concerns or considerations, or what should they understand before potentially placing
Yeah.
some money?
Yeah, if somebody falls in love with us, we're going to be a 5 to 15% allocation in an alts allocation. Most people are going to have, frankly, the lion's share of their business, again, based on their risk tolerance and their need for liquidity. But a lot of people are going to own stocks and bonds. And so in the past, it's been fairly easy and attractive to put someone in a 60/40, 55/35/10, stock to bond to cash portfolio. And quite honestly, the returns have been very good. But what we're seeing now, Brent, is a move together in correlations of traditional assets. So while stocks and bonds used to provide cover for one another,
Mhm.
the 60 in stocks would do well, maybe the bonds didn't, or the bonds would do well and the stocks didn't. And that worked really, really well. What we're seeing now is stocks and bonds beginning to correlate more closely together. And so now I think the desire to look for an alternative that zigs and zags at a different time than stocks and bonds do becomes attractive. So I think that's the benefit of owning an alt, whether it's us or real estate or private credit or whatever the case may be. I think the downside risk to owning an alternative is, it needs to be something you understand. It needs to be with a company that's done it for a long time. We've been in business 50 plus years. So we tell people we've had more yesterdays than anyone else in the business. We've done it under pretty much any condition you can think of. So, you don't want to just pick an alternative. You want to pick an alternative that you understand, that makes sense, and with a company that's done it for a long time and has a long track record. We've heard horror stories about people that have invested in things that they didn't understand, and with someone that did not have a great track record at doing it, and that can end poorly as well.
So what kind of, you mentioned that obviously there probably are a lot of players in this space that maybe shouldn't be there. And I'm sure that there's more that are entering every day. What do you see as a future trend for your niche in this world?
Well, I think I think that the good players in this space are going to innovate. They're going to get better. They're going to attract more assets. And I think that the players that aren't as innovative, that don't have the team, that don't have the people, they're not going to hang on to their asset. It's a very, very competitive business. So, we did a fairly massive reallocation in November of 2018. We allocated more assets to, I won't get too deep into the weeds, but some faster moving, more nimble models.
Mhm.
And when we compare ourselves against our peer group, there's been a huge separation in performance since November of 18. So we're not at all threatened by having lots of players in the space, because the cream's going to rise to the top, and the people that are innovative, that are really spending time focused on this business, are going to get better and better. And as they do, they're going to attract more and more assets, and they're going to get stronger. And then, quite naturally, what will happen is the players that don't do that are going to lose assets. Hopefully and does that make sense?
Yeah, that's the way of the world. I think with with every single business, you've got those that are going to continue to grow and succeed, and you have those that'll stagnate, and those that just won't be here.
That's right.
Um, for people that are curious, they want to learn more about Campbell and Company, they want to learn more about your strategies and your products. How they find you?
Well, we don't sell direct to the public. We only sell through financial advisors such as yourself. So, that's the beautiful thing about being on a podcast like this. No one would ever know who we were had you not brought this to their attention. So, it's just, reaching out to your advisor and saying, hey, I heard about Campbell. Is this a product that you have available? And then, we work with the advisor to educate the client. So that's pretty much the way they'd get involved.
Awesome. Well, John, I think it's a very cool strategy, and I think again that the fact you guys have been doing this for 50 plus years and changing and innovating with the time speaks volumes. So thank you for spending some time with us today and talking about what you do over there.
Well, it was my pleasure. And Brent, if you have any follow-up questions, or if people have questions after hearing about this, I'd be glad to answer those and help you out.
Appreciate it, John.
Thank you.
Yeah, Brent, you've done a really good job especially the last couple of months of looking at alternative investments. And I think it really answers a need for a lot of investors who are thinking, well, my stocks have done well. I don't see much traction in bonds, and I'm not quite sure where to go. So for people who are listening to this podcast and thinking, this guy makes some sense to me, maybe I should have a conversation with him, what's the best way for them to get a hold of you, Brent?
Yeah, our phone number in here is 602-255-0555. And there's always going to be somebody here to pick up the phone and answer. TWS.finance is our website. I'm pretty active on LinkedIn. I post something up there almost every single day. And you can reach out to me. You can DM me on LinkedIn. It is actually me on the other side of that. So happy to respond to people that way. And if you check out our website, there's pretty much every conceivable way to reach myself or a member of our team on the webpage.
Yeah, and I can attest to the fact that you are on the other side of that LinkedIn profile, because you and I have gone back and forth a couple of different times.
Yep.
For those of you who are listening to this podcast who are not yet subscribers, well, I don't know why you're not. So why don't you hit the follow button and become a subscriber? That way, every time Brent drops a new episode of this podcast, you'll be notified and you can give it a listen. The other thing that I would ask you on a personal basis is, if you like this podcast, tell people about it, share it with them. Word of mouth promotion is a really effective tool, and we would very much appreciate it as well. So until next time, I'm Bill Tucker. On behalf of Brent and everybody at the Wealth Stewards, thank you for taking the time to listen today. And I will remind you that you can go out today and make today a great day or not. The choice is yours. Use it wisely. Until next time.